I think in terms of asset allocation, our view over the next sort of 6 to 12 months is to sort of have more into fixed income because the yield are a lot more attractive than what they were before. And we see empirical evidence, at least in the US, that we're close to peak inflation. It doesn't mean peak interest rates or a Fed pivot in terms of cutting does.
Right, and that's really important.
That's important.
Right? That's what everybody else is looking at. Right.
So, but it means that you have a source of carry and yield that are quite interesting.
So Koku, thank you very much for joining me here. Great to have you on Make or Break, this episode on Real Vision. I've been wanting to chat with you for some time now because things in the markets recently have got hyper-focused on inflation. And as we sit down today, it was only last week that we saw the huge reaction. I think an 8% rally nearly in the NASDAQ following a slightly weaker than expected CPI print. As things are right now, I want to get your basically your impression of where we're at and how you see the consensus in terms of its belief that there will be a recession, presumably in the next year.
First, thanks for having me. I mean, we are in an amazing environment in terms of views, consensus when it comes to inflation and a recession. So obviously the word around stagflation and the combination of both. I think it's very important to take a step back and realize that we are in the midst of an inflation outbreak. And central banks are essentially injecting multiple doses of vaccines and boosters in the arms of the economy to quash this inflation outbreak. And the whole thing started with $25 trillion of monetary and fiscal stimulus in 2020 and 2021 to essentially help the economy survive the hibernation or the self-inflicted hibernation to save lives and livelihoods. And now we are in a super spreader event with that sort of inflation spreading across all aspects of the economy, from goods to services. Now, the argument that most investors we talk to on a regular basis have is that central banks will do whatever it takes to cure the economy from inflation, and the collateral damage will therefore be a recession. Because by raising interest rates, you ultimately create demand destruction, and therefore you break the wage price inflation or wage price spiral, and that ultimately leads to higher unemployment and therefore lower prices. The interesting argument or counter argument would be to simply say, when you look at household balance sheets in the US, for example, we're talking about $3 trillion of cumulative excess savings. That's roughly 10% of US GDP.
And that's a cumulative effect, because I know sometimes the charts get pulled up at the moment where it seems as though household savings are being drained down and the use of, say, revolving credit or credit cards has gone like that in the opposite direction. But this is a cumulative.
Correct.
Okay.
Because if you look at the latest data, clearly savings rate has been decreasing as households are dipping into their savings to deal with the cost of living crisis. But if you look at the excess deposits on households' bank accounts, the number is around $2.83 trillion of excess deposits of US banks accounts. And clearly there's a tilt toward the wealthier, because lower household income or household with the lowest income clearly don't save. They literally spend whatever they have. But it is interesting to think about this dynamic as a buffer against the cost of living crisis. Number two, corporate balance sheet. In my opinion, in 2021, a lot of corporates have literally deleveraged their balance sheet after a near-death crisis in 2020, where they literally were starved of cash and financing. So when you have a near-death experience and you have light at the end of the tunnel, obviously there's a quote that says there's always light at the end of the tunnel, but just make sure it's not an oncoming train. You sort of make sure that when you have the opportunity to get out of that liquidity crunch, you sort of repair your balance sheet. And this is what we saw in 2021. So you saw a lot of companies raising equities, etc. The main point here is that corporate profit margins are a lot healthier, and their balance sheet are a lot healthier than what they were, let's say, in 2008, for example, or in 2018 when the Fed was tightening. So you have a relatively resilient household balance sheet, relatively resilient corporate balance sheet, and then the big elephant in the room is employment, because in the US you have 2 job vacancies for every unemployed. Because of the great resignation around COVID, we lost something like 5 to 6 million workers from the US workforce.
And that can be seen in the participation rate as well, presumably, which has yet to recover.
Correct. I think we have 50-year-olds, for example, who have left the workplace. So you have a supply-demand imbalance in terms of goods and services, energy with the war in Ukraine by Russia, for example. But you also have a supply-demand imbalance in the job market. And the UK, for example, is obviously linked to Brexit and lower migration flows. So if you put all of that together, you are in a situation where it will need a lot more interest rate hike to deal or to inflict enough pain on the economy for that to lead to lower inflation or sufficient demand destruction to bring that inflation down. And this is why most investors expect a recession to occur towards the end of 2023, because it takes 3 to 4 quarters for all of this tightening to hit the economy. So it's a bit like a tsunami. You see the first shock, but then there's a shock wave that literally hits you a few hours, few months, few quarters in the case of interest rates hike and the economy. And this is why the recession could happen at the end of next year. Germany clearly is already in a recession given the severity of the gas situation. The UK clearly with the mortgage market and the mini budget debacle is obviously going to enter recession. But global economy are expected to be in a recession next year. But this is where, as we discussed at the beginning of this conversation, there is a situation or a scenario in terms of, if you look at all the distribution of outcomes, where we might simply go back to normality when it comes to interest rates. So it's no longer the zero interest rate policy or that we were used to before. And we might maybe be transitioning for this lower for longer to higher for longer, where 3-4% interest rates is the normality because the economies can take it, given all the dynamic that I was describing earlier, consumer, corporate, and essentially government intervention as well.
And that's what I really wanted to pick your brains on, because as I said at the beginning, it seems as though it's a very all or nothing view by the consensus at the moment out there in the market, where the peak or it's or we're never going to stop hiking. It seems as though there is clearly a different scenario that could play out here. A couple of things that you mentioned in the beginning. So the resilience of households in terms of level of savings, I think in terms of cumulative, that makes sense. So perhaps there is a greater buffer for them. Quite hard to fathom in terms of how perhaps we see some of the news flow at the moment, certainly on the news in the UK, where households are struggling clearly to pay bills, although clearly it's a lot more complex there and there's government support and X, Y, and Z going on around that. But I think the other key thing that you mentioned here is presumably the ability of corporates to absorb potentially more of the cost pressures and pass those on to the consumer. Is there not a risk, though, that is it greedflation? I think it's known as things can only perhaps go so far now, where some corporates have been really quite greedy in passing on when they have pricing pressure, passing things on.
So a few things to sort of disentangle here. I think the first one is this analogy with physics. So Newton's third law of motion, who says behind every action there's a opposite reaction or force. So, or in economics, this is the term called automatic stabilizers. So clearly when you have a cost of living crisis, you would obviously have government intervene to protect the purchasing power of lower income households. And that creates a new equilibrium. And when it comes to the way inflation propagates itself across the economy, there was this interesting New York Times article talking about greedflation, which simply says that when you are put in a position of power, most humans, as part of their sort of genetic makeup, will abuse their position of power. And we've seen a sort of generalized spread of inflation. And a lot of companies have been in a situation where they've been able to pass these higher input costs. And some of them have done so by more than what would be required because they had the opportunity to make a bit more profit margins or simply to preempt wage discussion or wage inflation discussion for next year. So what we have observed is that inflation is spreading faster than what it was theoretically do because of that human element of greed and what's essentially called greedflation. It's nothing new. It's simply a concept of monopolistic or oligopolistic situation where you are essentially able to dictate higher prices. But as you said, this can only run for some time, and demand destruction ultimately will bring people back to reality. And to quote a great philosopher, Mike Tyson, everybody has a plan until they get punched in the face. And I think this is where you make a very interesting point. Companies have the ability to pass on these inflation dynamic, but they are also immune to some extent to that inflation dynamic because when you talk about 10% inflation, it means average prices or selling prices or revenues are going up by 10%. Wage inflation is not at 10%, it's around 4, 5, 6%, depending on where you are.
Apart from those railroad unions in there.
True, we are asking for quite a lot more than that. But the average increase in input costs or labor costs is not matching that of the headline CPI. So you essentially have companies benefiting from operating leverage and this is why you're having earnings a lot more resilient than what you would expect given the underlying suffering in terms of consumption. So what I'm essentially saying is that when you have 10% increase in prices, you need 10% decrease in volumes to have flat revenues. And that's quite a big number to attain. So that's why most earnings consensus expectation is to have like 1 to 2% next year. But in real terms, these are actually bad numbers. But the market is looking at nominal numbers.
Hi, I'm Raoul Powell, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
When we talk about the difference between consumer prices and price shocks from commodity world, there's been a difference there. We talk about volume versus actual CPI. How do you see perhaps China also playing into that? There's clearly a lot of uncertainty and indecision at the moment, it seems, around whether or not large parts are remaining in lockdown or whether or not this is the beginning or is the reopening of China. The implications there for growth and also for commodities demand, presumably that also is something that sort of feeds into the economic picture. How do you see things?
This is a very good point. There are two forces and two very important themes. So the first one when it comes to China was the zero COVID, zero tolerance when it comes to COVID policy. And this has led to, if you look at copper, aluminum prices down 20% year to date because of the concerns around the real estate market. Because there's a lot less demand and a lot less sort of building and construction going on compared to the historical trend. As China reopens, then that could create a sort of increased demand and you could see a pickup in demand for commodities. And that's an important element to bear in mind because China has historically been exporting deflation or disinflation through cheaper labor workforce or labor supply, let's say. And now you could see a period of China potentially exporting inflation again. The other very, very important theme is really around greenflation and the energy transition.
Green with an N rather than a D.
Exactly. Not
okay, so we go from greed to green.
Greedflation. Okay. Greenflation. And this is very important because it's a multi-generational theme. Because if you think about the Biden inflation fighting plan or the European Green Deal, there is a need for significant amount of commodities to build wind farms, solar energy, etc. And this will require a huge amount of commodities and energy at a time when a lot of these mining companies and energy companies are being forced to reduce their capex and investment because of the negative environmental impact in terms of carbon footprint of their activity. So we are essentially in a situation where we have constrained supply with significant amount of demand. And this, according to Isabel Schnabel, who's a member of the ECB board, could lead to a period of sustained inflation, at least in the medium term, as the economy sort of switches to a more renewable world.
So for this, the longer term outlook does sound as though, yeah, we could still be in a period of inflation, maybe an inflationary regime longer term. We think, and people often draw the quick and perhaps slightly lazy comparison, as I'm about to hear, of looking at the 1970s as the last proper chapter or most recent decade of inflation. It sounds to me as though there could well be these the risk of recurrent inflation shocks if we are now in an inflation regime, assuming that the Fed or a recession does get inflation under control in the near term or near to medium term. How does this sort of play out in your view when it comes to, again, just bringing things back to this perhaps middle ground, if you like, where it's not peak inflation and it's not equally, rates going high forever. How does this sit with your thesis?
I think it's really a question of the shape of the peak of inflation. So if you remember in 2020, we were all using these alphabet soup letters, whether we'll have a U-shape, L-shape, V-shape recovery. I think today the big question is putting all these things upside down. Are we going to have an inverted V-shaped recovery, which is what the market was starting to price, and this is why we have a pretty strong rally, expecting the Fed to pivot? Or is it going to be more of an inverted U or inverted swoosh, where inflation plateaus and then takes time before going lower? In our opinion is that we'll see an inverted swoosh, because the Fed and central bank will have to keep interest rates higher for longer to bring inflation from the 6-7% down to the 2-3% target that they need. So it's very difficult to sort of assume this is a mission accomplished and job done when you start to see the inflation plateau, because to bring it down, you need a lot more tightening than what has been accumulated thus far. So our view is that that there's essentially more pain down the road and more tightening required. And then they might also be considering quantitative tightening as well. And we sort of tried that in the UK and didn't really go down very well in terms of financial stability. But I think, it's not an environment to necessarily go aggressively into risk assets.
You mentioned the UK there briefly, and without getting too far into the weeds of exactly what went on there, it's plenty of coverage and it's still a mess. Do you think that there's some potential policy divergence or just some difference in communication at the moment between, for example, the UK, the Bank of England, and the Fed? As you were speaking, I was thinking of what your views may be on the terminal rate, so where things end up, without necessarily putting an exact number on it. Whether or not it's a case of focusing on where the terminal rate ends up versus the pace of things. And the dichotomy, the difference between the two seems to be the Bank of England is suggesting that the terminal rate's not going to be so high, but the pace is going to be fast. So we're being steered towards focusing on the pace of tightening rather than the terminal level of rates. Whereas in the US, at least after the last FOMC meeting, of course it's changing all the time, but after the last FOMC meeting, Jerome Powell was very clear, he was explicit in saying terminal rate is probably going to be higher than you expect, but this is the ambiguity here. We may hike slower now than increase slower than previously expected. So in that scenario that we've just laid out, in terms of inflation perhaps being more persistent, the sequencing of how we get there, do you think this is a point where we go more slowly towards a higher terminal rate, or we're kind of pricing fairly where the terminal rate is? It's more a question of the pace.
So I think this is an excellent question. I think the Fed is fully aware of the lag effect between monetary policy, raising interest rates, and its impact on the economy. And this is why they've been talking about reducing the pace of the tightening, but not necessarily the end of the tightening cycle. Sort of to paraphrase Winston Churchill, it's sort of the end of the beginning versus the beginning of the end of the tightening cycle. And I think that we'll just need to see the incoming data over the next sort of few quarters to see whether inflation is really plateauing or whether it is essentially more inflation volatility. But I think it is fair to assume that the worst is behind us to some extent, and therefore, in terms of asset allocation, the 60-40 portfolio, which, by the way, died 7 times but was reborn 8 times. That was sort of a joke that I had with a client. Because as you saw, historically, we have sort of volatility when it comes to the equity bond correlation. But over time, as I was mentioning earlier, there are automatic stabilizers. And that negative correlation sort of reassert itself over the medium to long term.
Is that a relationship with, say, the equity risk premium, the relationship between fixed income and equity markets?
So in other words, bonds and equities going down at the same time or going up at the same time, which is typically a distorted phenomenon through QE.
What ultimately stabilizes it, though, when you mentioned the stabilizer effect?
So essentially, when you go to into a recession and inflation is quashed and less volatile, then bonds
become a resetting of inflation.
A safe haven, exactly. So you have bond becomes a sort of portfolio stabilizers, particularly as they are yielding a lot more than what they were yielding before. So I think the big problem we had in 2021 and 2022 were that bonds became the risk and not the safe, the risk-free assets, so to speak. And this is why some are thinking of moving from the 60-40 to the 40-60, i.e. allocating more into bonds as these yields are more attractive. And we even see some clients who used to look for equities for, let's say, 5% return in terms of quality income and things like that, looking at fixed income and high yield or actually investment grade credit as a source of sort of attractive yield in an environment where bond yield are a lot more interesting than what they've been in the past. So I think the path of least resistance is probably towards more allocation into fixed income than what we saw in the past.
And I think we saw that reaction as well in fixed income, not surprisingly, after CPI last week, where all of a sudden a 2-year Treasury at 4%, or 4+%, looked pretty good.
Absolutely.
In light of people speculating over a potential peak. And
correct.
Yeah, when you think about things, 10 years, 30s, around or slightly above 4% at the time of recording this, it's certainly an unusual proposition compared to certainly the last decade.
Yeah, I think it's unusual, but we also need to remember that sort of the system and the globalization of financial markets and the labor force, etc., could potentially be facing sort of generational shift around climate change. So think about supply chains, for example. Are they going to be as internationalized as they've been thus far?
So this is perhaps a deglobalization or fragmentation.
Exactly. And that could create changes in the dynamic of inflation and price setting mechanism. Sure. And this is why I think even though there's a scenario where we could have an equilibrium where interest rates are higher for longer and the economy could essentially survive this environment, there is the long-term risk of greenflation, as we talked about earlier, and that deglobalization theme could also jeopardize the sort of business as usual mindset that we've been accustomed to for the past few decades. So we might be going from a business as usual to a business as unusual environment with all these structural shifts that we are witnessing today. I think in terms of asset allocation, our view over the next sort of 6 to 12 months is to sort of have more into fixed income because the yield are a lot more attractive than they were before. And we see empirical evidence, at least in the US, that we're close to peak inflation. It doesn't mean peak interest rates or a Fed pivot in terms of cutting thus.
Right, and that's really important.
That's important.
Right? That's what everybody else is looking at. Right.
So, but it means that you have a source of carry and yield that are quite interesting. I think US IG and European IG looks very attractive. And when it comes to equities, we've sort of developed thematic baskets around the Green Deal in Europe. So all these companies that will benefit from all the investments made by governments around transitioning the current energy system to a more sustainable and renewable one. And I think this could also be another way to get exposure to the very commodity that will be needed for the energy transition in terms of building wind farms, solar panels, etc. So this is sort of aluminum, cobalt, lithium, etc. So it's quite unusual because you have a bit of a commodity barbell strategy, commodity and fixed income. But I think that's, from a risk-adjusted perspective, one of the most compelling sort of portfolio structure. Now, for the longer term, I think greenflation is a theme to focus more our time on, and it is likely to lead to more volatility of inflation. And this is where the bond portfolio might be unstable. But that's where dynamic and active investing is going to be more in favor as opposed to the passive buy and hold strategy.
Interesting. So I guess to just wrap things up, I think it's a pretty good way to leave it. The possibility of a plateau, we're talking about a possible peak, but maybe not the inverted V shape in inflation and therefore the sudden pivot in the Fed. That's the base case of the consensus, it seems, in the broader market, but that's not necessarily what we've just been talking about here.
Yeah. So to conclude, in physics, you typically, when you throw an object in the air, you rely on gravitational pull to bring it back down. So this is a classic inverted V. And we saw some of that dynamic in sort of shipping costs, for example, or used car sales prices, where you definitely had this transitory phenomenon for inflation. But when it comes to core inflation, we see more of a plateau, so an inverted swoosh, because bringing down inflation, think about a satellite in orbit back to Earth, is going to be quite unstable and volatile and risky. And this is where the Fed will have to tighten a bit more or keep interest rate higher to bring it back to their long-term 2 to 3% level.
Fascinating to hear your thoughts, Kokou. Thank you so much for your time today. Clearly, there's a lot more for investors to consider than simply this binary pivot of whether or not we've seen peak inflation.
Absolutely.
Could be a more nuanced view, certainly, going out over the next 12 months. Thank you for joining me.
Thank you for having me.
Well, what a fascinating interview that was. I certainly enjoyed listening to Kokou's thoughts. And when we break things down into key takeaways from that, what I'm thinking of is, first of all, the almost hysteria of the market currently, the consensus view that we're going to see a peak in inflation and therefore it's going to be followed by a pivot, is perhaps misled. There's clearly a third scenario, one in which we see a plateau in inflation and rate expectations, as Kokou outlined. And further to that, the implications for asset allocation from there, when it comes to perhaps yields offering some degree of diversification at current levels, but also the potential for the longer term investment themes linked to commodities around the green tech and energy transition theme are something which investors should also keep an eye on as well. In the near term, the bad news for the equity bulls and those betting on a pivot is that we might actually be entering a period, or a sustained period following this year, of ongoing volatility for equity markets. So we might well find ourselves in no man's land in the near term for stocks, but in the medium and longer term, fixed income and commodity-linked names could perhaps offer some diversification. So whether you agree with the view or not, hopefully it's expanded your horizons as it has mine, and put a little bit of nuance behind the otherwise binary debate of peak inflation and peak rates. Thanks for watching.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.